Welcome to video 5D on the types of income. So income gets classified by the tax law in just a ridiculous number of ways. And those classifications can actually differ depending on exactly what it is you're looking at. So we're going to talk about income from services versus income from property. And we got a little dose of that at the very end of the previous video where we talked about assignment of income for services versus property. We can talk about portfolio income versus income from an active business versus income from a passive business. And portfolio income we often think about as unearned income, right? So that's income that we don't earn, that it's being earned on some property that we hold, versus earned income we view as coming from our labor. And we'll cover some of this again when we do chapter 7. And then we also know from our character variable that we could have ordinary income and we could have preferential rate income, something like long-term capital gains or qualified dividends. Okay, so let's talk about income from services, and this is earned income. So for example, employee wages and salaries, non-employee payments for labor. So for example, your Uber driver, they're often not an employee of Uber, they're a non-employee, but they receive payments from Uber that are considered non-employee payments because they're independent contractors. Unemployment compensation. These are all forms of earned income as well as active business income. So for example, if you're participating in a business, like you own a pizza shop, or you're an accountant, or you're a doctor, or you're a lawyer, or you own a store, all those things would be active business income, and that's based on the services that you're providing. So Barney works 40 hours a week at Moe's as a bartender, and the wages he earns there, that's clearly earned income. But what if instead Barney just helped Moe clean out the grill once a year, and he did that in exchange for $100 worth of beer, right? So, hey Moe, I'll come over, I'll help you clean out the grill, just give me $100 worth of beer over the next, for Barney day, and we'll cover that. That's also earned income. So even though Barney wouldn't technically be an employee of Moe, that would still be earned income from the services that Barney is providing. Now, what if Barney is a distributor for Duff Beer? And I mean Barney owns the company that is a distributor for Duff Beer. He doesn't just drive the truck. And Moe purchases $12,000 of Duff Beer from Barney. Well, clearly Barney has income, right? But Barney will need to prepare some statement of business profits, but that will still represent income from his services or earned income, even though really it's the sale of inventory that's driving it. So just to make sure that we can try to make a distinction between income from services and income from property. Income from property we usually classify as unearned income. So I buy some instrument and it pays me, or this is being compensated for someone else using your property. So for example, when someone else uses your money, they pay you as either interest or dividends, right? So they're borrowing the money from you and they pay you back as interest, or you're investing in capital or equity and they're paying you back through dividends. That's when someone else uses your money. That's income from property. When someone else uses your tangible property, so a building, for example, or your equipment, that's rent. The income that you would receive from that, you would typically just call rental income, and that's income from property. When someone else uses your intangible property, like they license from you, or they franchise from you, or they pay you for a patent, that's a royalty. All these are forms of unearned income and income from property. Okay, so how about the sale of property? Do you remember back in Module 1 when we had Bart sell his stock? Remember, he bought stock, he could hold it year end, that was unrealized appreciation, or he could sell the stock at year end and have realized gain and then probably recognized gain. And we talked about this item, amount realized minus adjusted basis equals realized gain or loss. To the extent there's a deferral or an exemption, it wouldn't be, you back that out, and anything left over is recognized gain or loss.
Learn it, know it, live it.
So amount realized is the cash that Bart receives plus the fair market value of any property received, less any selling expenses, and then plus any net liabilities relief. So to the extent that the property was encumbered by some form of debt and Bart received some form of debt relief, that's also part of the amount realized. And we cover that in additional detail later in the course. The adjusted basis is generally the cost, to the extent there's depreciation or amortization, which again, we cover those later in the course, those adjust the basis. So again, we're back to this same thing. When we have a sale, exchange, or disposition, we need to know to do amount realized minus adjusted basis yields realized gain or loss.
Learn it, know it, live it.
So there are other types of income as well, and one of the significant ones is income from flow-through entities. So for example, a flow-through entity is a partnership, an LLC, a limited liability company, or an S corporation. And the reason those are flow-through entities is that the income flows through to the owners, and that's true whether it's paid in cash or not. So as a result, when it is finally paid in cash, it's often excludable because flow-through entities are only taxed once. So when income is included, the basis that you have in that flow-through entity generally goes up. When losses are passed through, the basis goes down. And we're going to cover that in a significant amount of detail later on in this semester. So Edna is a 25% investor in Crabapple Partners. In 2018, Crabapple Partners earns $1,000. Okay, so Crabapple Partners is a partnership. It's a flow-through entity. Edna's share as a 25% investor is $250. And that income flows through, Crabapple's income flows through Edna's share of $250 directly to Edna in 2018 when the partnership earns the money. So in a way, this breaks this cash basis rule that we were used to. Remember, we talked about how a cash basis taxpayer has to constructively receive the income. Well, from a flow-through entity, that simply isn't true. In 2019, the partnership, Crabapple Partnership, makes a distribution to each partner and distributes, let's say, $250 to Edna. Well, because Edna had already recognized that income in 2018, she doesn't recognize it again. She's already been taxed on it, and as a result, she'll typically not be taxed on the distribution of cash. And again, we'll work back from that assumption later on when we do partnerships and S corps. Okay, so another type of income is prizes and awards. So you go on a game show and you win a car. That guy who's crushing it in Jeopardy right now, that's all taxable income to him. However, there are 3 exceptions. The first exception is if it's a scientific prize and no future services are required by the taxpayer, and the taxpayer directs that prize directly to a charity. And you can think of this as the Nobel Prize exception because that is specifically what it was built for, Nobel Prizes. So a Nobel Prize, I think, is $1 million now. And if upon receipt, the taxpayer says, no, I want you to pay it directly to a charity. And of course, the Nobel Prize doesn't require the researcher to do any additional research. They just get it for past services. Then as a result, they could exclude that from their income. There's an exclusion for awards paid from an employer to an employee. And this is a very narrow exception because what we're going to gather last module, this module, further in this module, and in future modules is that when an employer delivers anything of value to an employee, there is a strong presumption that that is compensation and therefore income to the employee. So in this case, this is an exception from that. So when you give out length of service or safety awards to your employees, as long as they are a non-cash form and limited to $400, and they must be non-discriminatory. So that means you can't only give these awards to your highest paid employees. They have to go to all your employees, or they're based on safety. So for example, if Division 1 had a safety record for a year, they can get a safety award. If Division 2 didn't, they don't get it. That doesn't ruin this. That is discriminatory, but it doesn't ruin this particular award as being exempt. Now, if you look at footnote 26 on page 517, there's another $1,600 limit if the prizes are given under a qualified plan, which means you have to have a plan document, you live by that plan document, et cetera, et cetera, et cetera. But the average cost still has to be, or the average market value still has to be $400 or less. And then the third exclusion from prizes being taxable income is awards given to Olympic and Paralympic athletes. And there is a threshold by which that exclusion disappears, and that happens when the athlete has taxable income of more than $1 million. So I like to think of that as the Michael Phelps rule. Michael Phelps had millions and millions of dollars worth of endorsements for Subway. And so when he received his Olympic prizes and awards from the U.S. Olympic Committee, he would have to recognize those as income. Whereas think about like the luge rider. The luge rider never ends up on the Wheaties box. And so as a result, they probably are more likely to be able to exclude their Olympic awards. Okay. So Apu is an employee of Slushy Corp. And Apu needs to pay, he needs a loan to help pay for his kids' college. And so the Student Loan Association offers him $50,000 at 4.5%. But because Apu is such a great employee of the Slushy Corp, the Slushy Corp loans him $50,000. Luke, I'm not sure why it says Luke, loans Apu $50,000 at 0%. So they give him a 0% loan. Is Apu better off? And I think the answer is, yeah, absolutely, right? If the market would loan him that money at 4.5%, but his employer is willing to loan that to him at 0%, he's clearly better off in the 0% loan category. This creates an item known as imputed income. So when a taxpayer receives an indirect economic benefit, in a lot of instances, that creates taxable income. One of them is employee discounts or low interest loans. These generate imputed income. So the amount of imputed income for something like a loan is the difference between the amount of loan multiplied by the applicable federal interest rate and the amount of interest the taxpayer actually has to pay. So what happened is the IRS said, look, we know these loans happen all the time, and they do. And what we're going to do is we're going to publish what we think a reasonable market interest rate is for a loan of your duration. And if your stated interest rate is less than that, then that's imputed income, and you're going to have to work with that. However, the imputed interest rules don't apply to loans of $10,000 or less. So there's kind of a nuisance rule, like if you loan your buddy $500 and you don't charge him interest, no big deal. Okay, let's look at Apu's situation in detail. So he's going to get a $50,000 loan, and let's assume that the IRS's published applicable federal rate is 4%. So Apu should have paid 50,000 times 4% or $2,000. But instead, Apu paid 0. As a result, he has imputed income of $2,000. Since this came from his employer, it's almost certainly going to be treated as compensation income to Apu. So Apu also has $2,000 of offsetting interest expense. So remember, he's got income of $2,000, but he paid nothing. But he's got $2,000 of interest expense, but because that's probably treated as personal expense, it's probably not deductible. Okay, how about Slushy Inc.? Because remember, Slushy Inc. also received nothing. So Slushy Inc. gets to recognize $2,000 of compensation expense that offsets Apu's $2,000 of income. Slushy also has $2,000 of interest income. So net Slushy is 0. They deduct $2,000 of comp expense. They recognize $2,000 of interest income. Okay, so let's say that 5 years down the road, Slushy Corp forgives Apu's loan. Is Apu better off? Well, clearly, when someone forgives $50,000 of your debt, you are better off. And as a result, discharge of indebtedness or forgiveness of debt is treated as taxable income. Now, the IRS rules permit that to be excluded if the taxpayer is insolvent. Insolvent means their liabilities exceed their assets.
Apu, come quick! You're missing the miracle!
What?
Oh, my sweet husband. Say hello to your firstborn child.
Oh, you shall be the jewel of our lives.
Oh, now say hello to your other 7 children.
My... What?
We had quite a discussion about the funniest way to reveal them to you.
You have octuplets. It rolls off your tongue and into your heart. Octuplets.
Apu, you should have seen your face when they showed you those babies. Yeah, it looked just like that.
Okay, so here's a more common but considerably less material form of imputed income. So Lenny works at Lard Lad's Donuts, and each week Lard Lads allows employees to take home a free box of donuts, and the value of that box of donuts is estimated to be $6. Okay, so rather than have the employees try to steal donuts and take them home, instead they're like, look, we'll just give you a box every week for free. Just take them home. If you don't want them, fine, don't take them. But if you want them, you can take 1 box home a week, and that's on us. How would that differ economically from Lard Lads simply giving Lenny $6 and having him turn around and spend it on donuts? Economically, these are no different. So this is also a form of imputed income. Now, let's say that instead of giving them to free, it's a discount, right? So in the above example, it's just 100% discount, right? So the price would normally be $6 and we're just giving it away for $0. That's 100% employee discount. But what if it was 50% discount or 25% discount or a 10% discount? So the tax rules recognize that in certain instances, it might make good business sense for the employer to permit the employee to have a discount on the goods that they take. It reduces theft, it builds morale, it has the employees use, consume, whatever it might be, the employer's goods or services. And so in a way, like, it might make good business to have your employees have a discount. So what if it's a 10% discount? Well, again, because any transfer of value from an employer to an employee is likely to be construed as compensation, we might need a rule to prevent that from being taxable in all instances. And there is one. So when an employer provides a discount to an employee for goods, so for things, tangible things that they sell, that discount isn't taxable as long as it's never less than the cost that the employer paid for the good. If the employer is providing services to their employee, then the discount cannot exceed 20%. Okay, let's do an example. So Lenny is permitted to purchase a dozen donuts from Lard Lads for $4. And again, the typical selling price is $6. And the cost to Lard Lads is $3. So the way the tax rule is written is it says the gross profit percentage can never be more than the discount. So let's look at this case. The gross profit percentage in this case is 50% because Lard Lads would typically sell the donuts for $6. Their cost is $3. That means their gross profit is $3. $3 divided by $6 is a 50% gross profit percentage. Since the discount is $4, that's less. The discount, there's no imputed income because the discount is less than the gross profit percentage. Okay, let's say that Lenny is instead permitted to purchase these donuts for $2. And again, the typical price is $6. The cost of Lard Lads is $3. In this case, Lenny's discount is 66.67%, right? So that's $4 divided by $6. That's in excess of the gross profit percent. So that excess amount, the 16.67, has to be included as income. So as it turns out, $6 times 16.67 is $1. Now, the reason I don't like the way the book writes it, and frankly the tax code writes it, is, God, this gross profit percentage calculation just makes it more difficult. I like to look at it as Lenny's discount is $1 less than cost, right? His Lenny's discount goes down to $2. That's $1 less than Lad's cost of $3. That means he has to recognize $1 of income. Okay, Marge is a paralegal for Lionel Hutz. And Lionel Hutz is an attorney. And Marge decides to get divorced from home and goes to Lionel and says, will you please represent me? And Lionel says, sure. And because you're such a great employee, I'll represent you for $50 an hour. And Lionel would normally charge $80 an hour. Oh, excuse my yawn. The maximum discount percentage that can be excluded from income is 20%. So first we'd look at Marge's discount. We'd say, oh, $80 times 20% is $16. So the lowest non-taxable discounted charge could be $64. Since Marge is only being charged $50, she would need to include $14 per hour of whatever that is that he bills her as excess taxable discount and therefore included in her income. Okay, so here is just, this is out of a different textbook, but here's a giant list of types of income that are taxable. And that brings us to the end of Video D. Thanks for watching.
All right, here's your last question. What was the cause of the Civil War?
Actually, there were numerous causes. Aside from the obvious schism between abolitionists and anti-abolitionists, economic factors, both domestic and international, played a significant...
Yeah. Just say slavery.
Slavery it is, sir.
Yes, I am a citizen. Now, which way to the welfare office?
What?
I'm kidding. I work.